Welcome back to the deep dive. Today, we are undertaking a very specific kind of mission. We aren't here to speculate about future cryptocurrency prices. Instead, we are going to perform something like an autopsy on a recent high-profile Bitcoin prediction.
Yeah, one that failed spectacularly almost, well, immediately after it was published.
Exactly. And that's our focus, right? Moving past just the market noise.
Right. We're using this very specific case study. It involves Bitcoin, sure, but also key market indicators and maybe most critically undisclosed financial interests. Really is a textbook example.
A textbook example of how you, the listener, can recognize bias, how you can spot misleading information that's often kind of hiding in plain sight within financial analysis.
We want to arm you with actionable intelligence. The goal for this deep dive isn't just rehashing old news. It's about gaining knowledge, quickly but thoroughly.
And we do that by looking not just at the accuracy of the number predicted, which, spoiler alert, wasn't accurate, but really digging into the integrity and the likely motivation of the analyst behind it.
That's the key. We're trying to extract some universal principles here, stuff that applies to pretty much everything you might read in the, let's face it, very volatile crypto world.
Okay, let's set the scene then.
Right. So we're focusing on this extremely confident forecast. It was made by a guy named Martin Stransky. He's the founder of a pretty massive regional crypto operation called Bit.plus.
And this wasn't just some blog post. This claim was published on Kurzy.cz.
Yeah, which is typically seen as a trusted financial server in its region. The article dropped on November 7th, 2025.
And the forecast wasn't vague at all, was it? He didn't just say Bitcoin's going up.
No, he pinned it down. Said Bitcoin's expected range for the end of that year would be between, get this, $106,000 and $115,000 USD.
Wow. I mean, that's a very specific and entirely optimistic band. Putting a six-figure range on Bitcoin, it suggests absolute conviction, doesn't it? Like, he was sure the uptrend wasn't just continuing, but was going to accelerate rapidly.
That confidence is crucial to note. And, it's important to understand the market context just before the article came out.
Oh, yeah.
Leading into November, Bitcoin had been strong.
Right. There was some positive momentum.
Yeah, it reached a monthly maximum of $110,650 USD on November 3rd. So just for a moment there, that peak actually put the price within his forecasted band, briefly.
Okay, but here's where the timeline gets really interesting and kind of damning for the prediction. Immediately after that November 3rd high, the market didn't just pause or consolidate.
No, it saw a sharp correction, a painful one. We're talking Bitcoin subsequently dropping by a pretty substantial 10.6%.
10.6%, ouch.
So the article, the one containing this really rosy 106K plus prediction, published on November 7th. It came out during that dip, not during the euphoric run-up a few days earlier.
Ah, okay, so the price was already actively retreating from the kind of momentum he was forecasting.
Exactly, which makes the forecast seem out of touch almost immediately.
So let's look at the reality check. Our fast check source analyzed the claim just 2 days later, right? November 9th, 2025.
Correct. And as of that date, Bitcoin was trading at $101,838 USD.
$101,838. So doing the math, that placed the price a significant 3.97% below the lower boundary of his $106,000 projection.
Almost 4% below the floor, just 2 days after publishing.
Okay, let's unpack that. The key takeaway here seems to be the sheer speed of the failure. It wasn't just inaccurate in the long run, it was, like you said, non-current almost immediately.
Yeah, the prediction was effectively dead on arrival, DOA, a deviation of nearly 4% from the floor of a predicted range, just 2 days after publication. That strongly suggests one of two things.
Okay.
Either the analysis itself was, wildly lagging the actual market momentum.
Which would be incompetent, frankly.
Right. Or, and this feels much more critical, the intent was an objective analysis at all.
I think we kind of have to pursue that second path, don't we? If an analyst knows the market is dipping, I mean, it had already fallen over 10% from the recent, but they still publish an analysis forecasting that it will finish the year way up, above $106,000. That's not just a bad forecast. That sounds like pushing a predefined narrative.
Exactly. A narrative of growth regardless of the facts on the ground.
It tells us the number itself, the $106K or $115K, might have been secondary to the message.
Precisely. The immediate failure strongly suggests the analysis was structured around promoting optimism. The narrative seemed fixed. Bitcoin is going up. You should buy now. Forget this little dip.
Regardless of the active price action. Okay. That's a pretty serious charge.
And it brings us directly to what the source material identifies as the single biggest failing here. It matters way more than just missing the price target.
Okay, what's that?
The critical failure of transparency. We need to shift our focus entirely now away from the dollar figure and onto the identity and, importantly, the motive of the author.
Right. So let's dig into that. Who exactly is Martin Stransky?
Okay, so he is the founder and CEO of Bit.plus.
Bit.plus. And this isn't just some small-time blogger or independent analyst, right?
Not even close. This is a highly placed executive. And to really grasp the gravity of the conflict of interest here, we need to understand the scale of his company, Bit.plus.
And the scale, according to our sources, is actually immense, especially within its regional market.
Yeah, the sources describe Bit.plus as the largest operator of cryptocurrency services in the Czech Republic and Slovakia. We're talking a regional giant in the crypto space.
A giant. Do we have any numbers to back that up?
We do. The size of their operation really puts his analysis into perspective. Our sources detail a reported turnover of 1.5 billion Czech koruna. Okay, for our international listeners, what does that translate to, roughly?
Well, exact exchange rates fluctuate, of course, but 1.5 billion kite translates into tens of millions of US dollars. It's a significant multi-million-dollar revenue stream annually. They are a massive player in the European crypto market.
Tens of millions in turnover. Wow. And it's not just online, is it? Their operation has a physical presence.
A huge physical presence. They operate a staggering 440 branches.
440? Yep. And these aren't just, websites or apps. This infrastructure includes physical exchanges, actual Bitcoin mats, crypto ATMs, and sales points at various G-co-locations, which are like convenience store chains.
So they are deeply physically embedded in the actual mechanics of buying and selling crypto in that region.
Absolutely. So let's connect the dots. We have the CEO of a company with tens of millions of dollars in turnover,
Okay.
whose entire business model is basically predicated on one thing: transaction volume and asset growth in the crypto market.
Right. They make money when people buy and sell crypto, and ideally when the price goes up.
Exactly. So when a figure like that, the CEO, issues an analysis, that analysis simply cannot possibly be detached objective market commentary. It's inherently tied to their company's bottom line.
Okay, so here's where the undisclosed financial incentive comes into really sharp focus. Bit.plus profits by facilitating the trading of Bitcoin and other cryptocurrencies.
They make money on the volume, the spread, the fees associated with transactions.
So every optimistic forecast, every time Stransky suggests Bitcoin is going to hit $115,000 and basically implies people should buy now.
It directly achieves two things for his business. First, yeah, it might contribute a tiny bit to overall market optimism, which could help push prices up generally.
Okay, the rising tide lifts all boats idea.
Sort of. But second, and probably much more importantly for Bit.plus specifically, it drives volume. People read the optimism, maybe they get FOMO, they rush to buy.
And where do they buy? They might use his exchanges, his Bitcoin mats.
Exactly. And Bit.plus makes money on every single one of those transactions.
So the conclusion drawn by our source material seems pretty unavoidable then.
It really does. That specific, highly optimistic prognosis of $106K to $115K primarily serves as marketing for the author's own company.
It's not analysis seeking truth. It's essentially a sales pitch disguised as expert commentary.
Precisely. And the critical failure, the real sin here, is the omission. The article published on Kurzy.cz entirely failed to disclose Stransky's position as the CEO of Bit.plus.
So readers wouldn't necessarily know who he was or what his company did.
Exactly. It gave the impression of potentially independent expert analysis. It completely failed to alert readers to the significant, very material conflict of interest.
There was no disclaimer. No, Mr. Stransky is CEO of Bit.plus, a major crypto exchange.
Nothing mentioned in the analysis we reviewed. No reminder that the author is a direct market participant controlling a huge exchange network that profits directly from the very optimism he was promoting.
Wow. So you, the reader, you just have no idea that the source of this high-octane optimism is literally a dealer in the very thing he's recommending you invest in.
And that lack of transparency, it just poisons the well completely, doesn't it? It makes the objectivity of the entire piece pretty much invalid from the get-go.
It's a fundamental issue of disclosure or, well, the lack of it. And we see this kind of thing again and again in high-stakes markets, unfortunately.
And the scale of the business, that 1.5 billion koch turnover, those 440 branches, it just makes the omission even more, well, egregious.
Yeah, this wasn't some casual blogger offering a friendly opinion over coffee.
Not at all. This is a major market maker with massive financial infrastructure, effectively promoting his own product line via a third-party, supposedly respected news outlet.
Without telling anyone that's what was happening. Okay. That's failure number one. Transparency. What else?
Well, beyond that huge issue of transparency, the analysis also failed on a second core principle, contextual misrepresentation.
Contextual misrepresentation. Okay, what does that mean? Is that different from just being wrong?
Yeah, it's often far more subtle. It's a kind of manipulation, really. It's where analysts might use legitimate, recognized technical indicators, but they selectively strip away crucial context
Why would they do that?
to make the indicator fit a predetermined narrative. In this case, the optimistic narrative that served his company's interests.
Okay, so how did that play out here? What indicator did he use?
They chose a specific and rather dramatically named indicator, the Hindenburg Omen.
The Hindenburg Omen. Sounds ominous. What is that for people who haven't heard of it?
Yeah, it does sound very dramatic. It's a technical analysis pattern that's supposed to appear when the stock market is showing extreme internal divergence.
Convergence, like things moving in opposite directions.
Exactly. It means a large number of stocks are hitting new 52-week highs, while at the very same time, a large number of other stocks are hitting new 52-week lows. It's meant to signal this internal weakness, this sort of tearing apart within the market that supposedly precedes a crash.
Okay, so it's generally seen as a warning sign.
A potential warning sign, yes. Now, the article referenced this omen. It specifically stated that it signaled a potential sharp drop of 5 to 7%.
5 to 7%. That sounds like a pretty dire warning to include in an otherwise optimistic piece.
It does. But then, almost in the same breath, the author pivoted dramatically. He acknowledged this potential 5-7% drop signal, but then predicted rather a calm down, and crucially, maintained his very bullish 106K plus forecast for Bitcoin.
Wait, so he brings up the scary-sounding crash signal, only to immediately dismiss it.
Pretty much, yeah. And that immediately raises an important question, doesn't it? Why even mention a potential 5-7% crash signal if you're just going to brush it off without offering any real substantive analysis to counter why it won't happen this time?
Good question. What's the answer, according to the analysis?
The answer seems to lie entirely in the selective omission of vital data about the omen itself.
Ah, okay. So he presented the omen as the serious, maybe even frightening warning sign.
Right, which makes the analysis appear balanced and nuanced, like, see, we're considering the risks.
But he conveniently failed to mention the crucial context regarding the indicator's actual real-world reliability.
Bingo. And the facts about the Hindenburg Omen, especially when people try to apply stock market indicators loosely to the cryptosphere, are pretty damning.
Yeah, damning.
Well, studies consistently show that 75–80% of its signals are false alarms.
Wait, say that again? 75 to 80%.
Correct. That means, statistically speaking, if you panicked and sold or bet on a crash every single time the Hindenburg Omen appeared, you would be wrong roughly 4 out of 5 times.
So its actual predictive accuracy is only somewhere between 20 and 25%.
That's right. Which is...
No, not great.
Not great. That's a staggering figure. If an indicator is only right about 1/4 of the time, it's statistically unreliable. I mean, it's frankly almost useless for making high-stakes financial forecasts, isn't it?
It really is. It's more noise than signal, statistically. So think about what the author did. He presented this known warning signal, the Hindenburg Omen, but crucially withheld the fact that this indicator is statistically expected to be nothing most of the time anyway. Like 75–80% of the time, it just fizzles out.
Okay, so he created a misleading narrative.
Precisely. The narrative becomes, look, we acknowledge risk. Here's the scary omen. But we are so confident in the underlying uptrend that we're going to dismiss this risk.
But the dismissal wasn't based on some novel insight or counter-analysis he provided. Nope. It was implicitly based on the known statistical unreliability of the omen itself, a fact which he did not disclose to the reader.
Wow. That's clever in a sneaky way.
It is. He essentially took a fundamentally noisy indicator, leveraged its frightening name to make himself look thoughtful and aware of risks,
and then confidently maintained his optimistic sales pitch anyway, which just happened to align perfectly with his business interests.
It's the ultimate form of spin, really. The lack of that crucial contextual data, the 80% failure rate, transforms the analysis from anything resembling objective reporting into just persuasive marketing.
Okay, that's a really important lesson, I think, for any reader of financial news, or crypto news especially.
Absolutely. Whenever an analyst cites any technical indicator, your very next question must always be, okay, but what is the historical accuracy rate of this indicator? How often is it right?
And if the analyst doesn't provide that context,
then you should be very suspicious. They're likely using the indicator more for dramatic effect or to build a narrative rather than for genuine analytical insight.
Demand context. Got it. So failure on transparency, failure on context. What about the platform itself?
Yeah, these failures of transparency and contextuality are clearly tied directly to the analyst, Martin Stransky, and his company's interests. But now we kind of have to turn our critical eye towards the platform that actually hosted this, well, flawed content.
You mean Kurzy.cz?
Exactly.
Yeah.
Because the environment, the publication where an article appears, it really dictates the reader's initial level of trust, doesn't it? And it seems like that environment failed here, too.
It does seem that way. As we mentioned, Kurzy.cz is traditionally regarded as a highly trustworthy server for financial markets in its region. People go there expecting reliable information.
Right. So when you, the reader, encounter an article on a platform you generally trust, you're naturally conditioned to assume a certain baseline level of editorial rigor, right?
Yeah.
You assume someone checked it, that there's some fact-checking, and maybe most importantly, some commitment to objectivity.
That's the implied promise of a reputable news source. So the publication of an optimistic, conflict of interest-laden article like this one, without adding a mandatory, crystal-clear disclosure about the author's massive commercial ties.
Ties to a business turning over 1.5 billion kucha, remember?
Right. Doing that severely, and I'd argue immediately lowers the server's own credibility.
The reader's assumption is the core issue here, like you said. They assume, quite reasonably, that a trusted platform like Kurzy.cz has performed some level of editorial review, that they've verified the content, checked its objectivity.
Or, at the absolute minimum, they'd expect the editorial team to flag the author's direct, substantial financial involvement in the subject matter, like a big warning label.
You'd think so? But by failing to do this, Kurzy.cz essentially lent its credibility, its platform's trust, to what was, as we've established, effectively a piece of corporate marketing disguised as independent financial analysis.
They transferred their hard-earned institutional trust directly onto an interested party, the party who stood to profit.
And think about the institutional damage that does long-term. When readers eventually realize they might have been consuming marketing disguised as news on a platform they trusted.
Yeah, that trust erodes quickly. Not just for Kurzy.cz, but potentially for financial news in general.
Exactly. This specific case really shows how quickly that trust, which is so hard to build, can be, well, fungible or easily lost. When a reputable source allows a market participant with millions, potentially billions, at stake
to publish what amounts to a sales pitch without clearly disclosing who they are and why they might be saying it.
that trust just dissolves, and it makes it exponentially harder for the average investor, the average reader, to distinguish genuine analysis from slick advertising in the future.
So the publication, maybe through simple editorial oversight, maybe something else, effectively became an accessory to the failure of transparency.
That's a harsh way to put it, but it's functionally true in this instance. This wasn't just a failure of forecasting by one individual. It arguably represents a failure of the editorial firewall that's supposed to protect the reader from exactly this kind of self-interested promotion.
Okay, so we've dissected the prediction, the author, the context, the platform. Let's try to pull this all together into something useful for the listener.
Right. We've picked apart the immediate failure, the transparency failure, and the contextual failure of this specific Bitcoin prediction. But the real value of this deep dive for you, the listener, is synthesizing those specific findings into actionable, universal rules.
Rule you can use going forward.
Exactly. These are the principles you should try to apply to basically every single crypto prediction or piece of analysis you read, regardless of the asset, Bitcoin, Ethereum, Dogecoin, whatever.
Okay, so we've distilled this process down into 3 essential principles based on this case study. These are really your key takeaways for assessing knowledge sources in this often confusing space.
Let's lay them out. Rule number 1, always verify the author.
Always verify the author.
This is the absolute non-negotiable first step. It's the one that immediately caught the Stránský prediction red-handed, if only the disclosure had been made. You must establish who is writing the article.
And what are we looking for specifically?
You need to ask, does that person or the organization they represent have a direct financial interest in the subject matter they are discussing?
Okay, let's define direct financial interest a bit more clearly. What does that encompass?
Well, the obvious one, like here, is running an exchange or brokerage that profits from trading volume, like Bit.plus. But it also includes things like, are they selling courses related to the asset?
Like learn my secret Bitcoin trading strategy.
Exactly. Or are they a core developer or major token holder who profits directly from the asset's price appreciation or increasing transaction volume? Are they running a mining pool?
So basically, do they make money if you buy or trade this thing?
That's the bottom line. If the answer is yes, you must automatically treat their analysis or prediction with extreme skepticism. You should probably view it primarily as potentially biased marketing, not objective analysis.
Because if the author profits directly from your investment action.
Then their primary motivation is very likely not just to inform you, but to influence you to act in a way that benefits them financially.
Okay, that's rule 1. Verify the author and their financial interest. What's rule 2?
Rule number 2, control the sources and citations.
Control the sources, meaning check their work.
Exactly. Look beyond the sensational claims, the big price targets, the exciting narratives. Ask the simple question, are the underlying data points and the major claims being made actually supported by evidence? Are they cited?
Good analysis should show its work, right? Like in math class.
Precisely. Good analysis isn't afraid to link to data, to methodologies, to supporting research. Biased analysis, or just lazy analysis, often asks you to simply trust the conclusion without showing the steps.
And in the Stransky case, you mentioned the basic Bitcoin price data was roughly correct.
Yeah, the historical price points mentioned were generally okay, but the prognosis, that huge leap to $106K, $115K, was wildly unsupported by any presented evidence or robust methodology in the piece we looked at.
And especially with the Hindenburg Omen example.
Perfect example. If an analyst discusses complex concepts like technical indicators, they must ideally cite sources or provide data that analyzes the indicator's known accuracy and reliability, not just mention its name for effect.
We saw how omitting the Hindenburg Omen's terrible 75–80% false alarm rate fatally undermined the credibility of that whole section of the article.
Right. So you, the reader, must demand context behind the claims, and especially behind any cited indicators. Don't just accept them at face value.
Okay. Rule 1, verify author. Rule 2, control sources. What's rule 3?
And rule number 3 is track the record.
Track the record. Whose record? The author?
Yes, the author or the publications. Consistency and independence are vital signs of credibility. Does the author have a verifiable history of accurate predictions? More importantly, is their track record generally objective and independent of their own personal financial interests?
So we're looking for patterns.
Exactly. If an analyst is consistently wrong, well, that tells you something. But also, if their only seemingly successful predictions just happen to align perfectly with their company's financial interests.
Like maybe they only predict massive growth right before their company releases a new product or service related to that asset.
Precisely. If that's the pattern, their track record is compromised. It suggests their predictions might be driven by commercial needs rather than objective market reading.
And the Stransky prediction, being dead on arrival almost instantly,
certainly didn't help build a case for his predictive accuracy. It reinforces the suspicion, based on Rule 1, that this might have been an opportunistic prediction serving a corporate agenda rather than a serious forecast.
So you have to look for consistency, accuracy over time, and crucially, independence of the predictions from the analyst's own profit and loss statement.
That's the trifecta. So when our source material summarized the Stransky prediction based on these 3 rules, it failed across the board.
Let's recap the failures.
Failed on transparency. The massive conflict of interest was omitted. Failed on contextuality. The high unreliability rate of the cited Hindenburg Omen was omitted. And failed, or at least highly questionable, on objectivity. The relentlessly optimistic tone perfectly matched the author's clear financial interest in market optimism and volume.
The lesson seems stark, as the source concluded. The big dollar number was just noise. The undisclosed financial motive was the real signal here.
Well put.
Okay, these rules make sense. But do they only apply to big, established coins like Bitcoin where huge companies are involved? What about newer emerging projects?
Yeah, I think it's vital to show that these rules aren't just for the big players. They apply universally across the crypto landscape. So let's try to connect these lessons to a specific, quite different example that was also detailed in our source material.
Okay.
Something that exists far outside the, high 6-figure Bitcoin price tag discussion. Let's talk about the Pi network.
Ah, Pi network. Yes, that's an interesting one.
Because it shows that the need for deep scrutiny using these same rules is identical whether the coin is supposedly trading for $100,000 or like Pi, is still in the process of launching its main network and doesn't really have a widely accepted market price yet.
That's a great point. The Pi network is a fascinating phenomenon in itself. It launched back in 2019, and a key part of its branding is that it was founded by a team of Stanford University PhDs.
Right, which immediately gives it this sort of veneer of academic credibility, doesn't it?
Yeah.
Makes it sound serious and well thought out. It does. And its primary draw, the thing that got millions of people involved, is the premise of really simple, accessible, and supposedly ecological mining.
Simple is the key word there, I think. How does the mining work?
It's incredibly low friction. Users supposedly mine Pi coins by simply opening the mobile app and pressing a single button once a day. That's it.
Just press a button once a day?
Yep. The app then simulates mining for a full 24 hours, even if the phone is idle or offline. Compared to the, complex and energy-intensive process of mining Bitcoin, this sounds incredibly easy and low effort.
And that simplicity must be why it's drawn in such a massive global community of users, right? Millions of people.
Absolutely. Millions worldwide. And the network's stated goals sound compelling too. They aim to increase the utility and therefore eventually the value of the Pi coin by enabling users to create and use web applications directly on the Pi platform itself, building an ecosystem.
Okay, and how does it grow? Is there an incentive to bring others in?
Very much so. The scaling mechanism is highly reliant on network expansion through referrals. Users can increase their individual mining speed by building their personal network, basically, by getting others to sign up using their referral code. It's a core part of the system.
And where is the project now? You said it hasn't fully launched.
Correct. Currently, the project is in the protracted process of launching its functional main network, or mainnet, where the Pi coins might eventually gain real utility and potentially monetary value.
Okay. So even with Stanford founders and claims of ecological mining, the need for rigorous fact-checking, applying our rules, seems just as important here, maybe even more so given the lack of established value.
Absolutely constant need. Our source material points directly to the intense speculation and, frankly, misinformation surrounding this project. It even mentions related article titles that explicitly question some of the wilder claims.
Like the one asking about the Pi network and 314,159 USD value, the biggest hoax in the history of the project.
Exactly that one. That number, $314,159 per Pi coin, which is derived from the mathematical constant pi, has become this sort of mythical price target within parts of the community. It highlights the high level of hope, bordering on delusion sometimes, and the outright falsehoods circulating among the user base.
So let's apply our 3 rules here. Let's start with rule 1. Verify the author motive. How can we apply that to Pi? Based on the source details.
Well, we can look closely at the participation mechanics detailed in the source. This is often where you find clues about the true nature of the incentives and who really benefits.
Okay, what are the mechanics?
The participation process itself is quite strict. You must use the official mobile app, and critically, you must enter an invitation code from an existing user to even join.
Ah, so that referral system isn't optional, it's mandatory to get in. That immediately builds this powerful hierarchical referral structure, doesn't it?
It does. Now let's look at the transparency and commitment requirements, which relate directly to motivation and control. The Pi network requires quite stringent Know Your Customer, or KYC, compliance from its users.
KYC, can you just quickly remind listeners what that involves?
Sure. Know Your Customer, KYC, is a standard, often mandatory process in regulated financial services. It requires the verification of a client's identity, usually through official government documents like passports or driver's licenses. It's a crucial regulatory step designed primarily to prevent things like fraud, money laundering, and terrorist financing.
Okay, so Pi requires this formal identity verification. How does that work in their system?
The source material details this KYC requirement with a bit of a twist. Users must pass KYC, submitting their real documents after they've completed 30 daily mining sessions, and crucially, they must have used their real legal name during the initial registration process.
Their real name, that's non-negotiable for participation.
Apparently so, if they want to eventually claim any Pi they've mined on the mainnet. But here's the real kicker, the detail that really makes you think about Rule 1. Verify motive. If users registered incorrectly, say they used a nickname, or if they fail or refuse KYC, they face a potential, rather punitive penalty.
A penalty? What kind of penalty?
According to the source, potentially losing a significant portion, maybe 20% or more, of the Pi they thought they had accumulated.
20%. Wow, that's a huge penalty. That seems quite strict for something pitched as simple, accessible, community-driven mining.
It does, doesn't it? It transforms this simple ecological mining narrative into a high-stakes protocol that demands genuine, real-world identity verification and long-term commitment, backed by a significant financial penalty for non-compliance.
So why would an allegedly accessible community project impose such a punitive measure? What's the potential motive there?
Well, on one hand, it helps enforce the legitimacy of their claimed user numbers. For potential future partners or investors, they can say, these are real, verified people. But on the other hand, it also means that the core organizers, the founders, gain massive leverage and control over a significant, globally distributed, and personally identifiable population. They know exactly who their users are.
Okay, so that connects directly back to Rule 1. When you see those spectacular, maybe unbelievable value claims about Pi, like that absurd $314,000 value hoax, you absolutely must ask, who benefits if I believe this number?
Exactly. Who benefits from keeping millions of users engaged daily, clicking that button, expanding the network through referrals, and submitting their verified identities, all fueled by the hope of spectacular future returns?
The people who benefit most are likely those who control the core protocol, the mainnet launch, the future ecosystem development, and potentially any monetization paths down the road.
Precisely. Their motivation isn't necessarily aligned with the individual user hoping to get rich quick.
And Rule 2, control sources. That applies to Pi's claims about technology, ecology, future value.
Absolutely. Are the claims about its technological innovation independently verified? Are the ecological claims backed by transparent energy audits? Are any future value projections based on audited economic models and potential real-world adoption? Or are they just based on community enthusiasm and referral growth? Need to check the substance.
And Rule 3, track record. That seems especially relevant for these emerging projects where there's no long price history.
Yeah, for emerging projects like Pi, we can't check a multi-year track record of price accuracy because there isn't one yet. But we can check the track record of the project's delivery and transparency to date.
How so?
Well, have the founders been consistently transparent about the project's development milestones?
Yeah.
Have they met previous roadmap targets? Are they clear about the project's eventual monetization strategy? Or is that kept vague? Are the financial projections, if any, based on concrete factors or just hype? You look at the history of their actions and communications.
So the takeaway here really is universal, isn't it?
I believe so. Whether you're looking at a multi-billion-dollar established asset like Bitcoin, analyzed by the CEO of a major exchange, or you're looking at an emerging project like Pi with millions of hopeful users and PhD founders, the fundamental rules for critical evaluation are exactly the same.
Scrutinize the source's motivation and potential conflicts of interest. Rule 1.
Demand verifiable evidence and full context behind all the claims and numbers. Rule 2.
And assess projects or authors' history of honest engagement, transparency, and delivering on promises. Rule 3.
Transparency about identity, motivation, and evidence must always precede any level of trust you place in a prediction or a project's claims, especially in crypto.
Excellent. Okay, let's wrap this up. Hashtag tag outro. So this deep dive, I think, successfully used one very specific, almost immediate failure, that Martin Stransky Bitcoin prediction as a lens. A lens to establish 3 essential and hopefully memorable universal rules for trying to distinguish quality analysis from what might just be marketing recommendations in the crypto sphere.
And just to recap those quickly, Rule 1, always verify the author's direct financial interest. Do they profit if you follow their advice?
Rule 2, control the sources. Check for real evidence and full contextual information, especially things like the historical reliability of any technical indicators they mention. Don't accept claims blindly.
And Rule 3, track the author's or project's verifiable record. Look for a history of accuracy, independence, and transparency over time.
And if we connect this back to the bigger picture from our Bitcoin example, it really seems to clearly show that marketing very often disguises itself as objective analysis, doesn't it? Especially where huge amounts of money, billions of dollars, are potentially at stake.
Absolutely.
Yeah.
The most important knowledge you, the listener, can gain is often not about predicting the future price accurately. It's about understanding the incentive structure behind the prediction you're reading. You've always got to follow the money behind the mouth.
And we saw how even a seemingly trustworthy site, Kurzy.cz in this case, risked its own reputation and credibility, perhaps inadvertently, by publishing content that clearly served the interests of a company with massive turnover, all without proper disclosure.
Yeah, that failure highlights a potentially deep institutional issue in financial reporting, especially in fast-moving, less regulated markets like crypto.
Which leads us directly into our final provocative thought for you, the listener, to maybe chew on after this.
Okay.
If the basic disclosure rules, just telling people who the author is and what their company does, failed so clearly in this case, allowing an article that basically served a multi-million-dollar business interest to run unfiltered on a trusted platform, then what further institutional safeguards, perhaps going beyond just simple disclosure flags, do you think the financial media needs to implement?
Good question.
How can they truly regain and maintain trust when they're covering these incredibly high-stakes assets, where the source providing the analysis might have billions in potential profit riding on the outcome? How do we actually build a truly effective, robust editorial firewall in this environment?
That's a tough one. Definitely something worth mulling over. How do you ensure integrity when incentives are so skewed?
Something for you to explore on your own?
Indeed. Well, we look forward to diving deep with you again soon.
We'll see you next time on The Deep Dive.